There is a single decision that separates the wealth of the few from the frustration of the many. It is not a complex algorithm, it is not a secret stock tip whispered in a back room, and it is not a prediction about where the market is headed tomorrow. It is a quiet, disciplined, and profoundly powerful act of refusal. It is the art of saying no. In the glittering casino of the global markets, where every ticker symbol screams for your attention and every news headline promises the next hundredfold return, the most profitable skill is not the ability to pick the winner, but the wisdom to dismiss the thousands of potential losers without a second thought. This is the central operating principle of the man who turned a small textile mill into a $500 billion fortress of capital, Warren Buffett. His genius is not cataloged in the list of stocks he has bought, but in the mountainous pile of opportunities he has calmly and deliberately rejected. He calls it his too hard pile. It is the most important concept in modern investing, and it is the one most people ignore at their own peril. This is not a story about a clever buying strategy. This is a story about the construction of a mental shield, a fortress that will protect your capital, your sanity, and your financial future from the single most destructive emotion an investor can ever feel: the fear of missing out. FOMO. That feeling, that itch in your gut when you see a stock soaring without you, is not an investment signal. It is a biological trap, a siren song luring your portfolio onto the rocks. The too hard pile is the discipline that cuts the cord, that silences the noise, and that allows you to operate on a plane of rationality that 99% of market participants will never reach. Today, we are not just going to talk about this idea. We are going to build it. We will deconstruct this principle into its fundamental pillars, transforming it from a folksy piece of Warren Buffett advice into a rigorous, actionable system for your own investment strategy. You will learn to define the stark boundaries of your own knowledge, to weaponize the psychology that works against others, to embrace the profound power of doing nothing, to demand radical simplicity in a world that worships complexity, and to unlock the incredible compounding force of pure, undiluted focus. This is the journey from being a speculator, tossed about by the whims of the market, to becoming an intelligent investor, a true business owner who dictates their own terms. This is the first and most critical step toward genuine financial discipline and lasting wealth building. The entire architecture of Warren Buffett's success rests on a single, humble admission: I don't know. In a world of pundits and prognosticators who are paid to have an opinion on everything, Buffett's primary intellectual weapon is the clear-eyed recognition of his own limitations. This isn't false modesty, it's the very foundation of his risk management. He calls this boundary the circle of competence, and everything outside of it belongs in one place: the too hard pile. This isn't just a quaint metaphor. It is the genesis of his entire investment philosophy. The goal is not to have the biggest circle, to know a little bit about everything. The goal is to know, with absolute certainty, where the edge of your circle lies, and to never, ever step outside of it. For Buffett, this means sticking to businesses he can understand fundamentally, businesses whose economics he can reasonably predict a decade or more into the future. It's why his portfolio is filled with names like Coca-Cola, American Express, and See's Candies, and for decades was famously devoid of the technology titans that dominated the headlines. The too hard pile is the physical manifestation of this discipline. It is a mental container where he tosses every company, every industry, every investment proposal that does not meet this strict, simple criterion of understandability. And once it's in the pile, it ceases to exist. There is no regret, no second guessing, no fear of missing out on a potential winner. The decision is final. This first pillar is the most crucial because it dictates the entire universe of possibilities. Before you can even begin to analyze a balance sheet or calculate a valuation, you must first answer the question: is this even a game I am qualified to play? The late 1990s were a difficult time to be Warren Buffett. The world was in the throes of the dot-com mania. a euphoric frenzy where any company with a .com at the end of its name saw its stock price rocket to celestial heights. It was a new paradigm, they said. Old metrics like profits and revenues were relics of a bygone era. The new economy was about eyeballs, about network effects, about capturing land in a digital frontier. And in Omaha, Nebraska, the world's most famous investor was sitting it out. He was buying bricks and carpets and furniture. Barron's, the influential financial magazine, ran a cover story in 1999 with the headline, "What's Wrong, Warren?" The article questioned if Buffett, the Oracle of Omaha, had lost his touch. He was a dinosaur, a relic of an industrial age, utterly failing to grasp the revolutionary power of the Internet. The pressure was immense. His own shareholders at the Berkshire Hathaway annual meeting were questioning him. Friends and colleagues were getting fabulously rich on stocks like Yahoo and GeoCities. Meanwhile, Berkshire's stock was languishing, underperforming the S&P 500 by a wide margin. In this cauldron of doubt and ridicule, Buffett's response was a masterclass in intellectual honesty. He didn't try to pretend he understood the new tech landscape. He didn't hire a team of young analysts to chase the trend. He simply and publicly admitted his ignorance. At the famous Sun Valley Conference in July 1999, an annual gathering of media and tech moguls, Buffett gave a speech that has since become legendary. He didn't talk about the Internet. He talked about the history of other transformative industries, like aviation and automobiles. He methodically demonstrated that while these technologies had changed the world, they had been disastrous investments for the vast majority of people who had poured capital into them. Hundreds of car companies had gone bankrupt. Dozens of airlines had failed. He wasn't saying the Internet wasn't revolutionary. He was saying he had no way to reliably pick the one or two winners from the hundreds of competitors, most of whom had no profits, no durable competitive advantage, and no clear path to long-term profitability. He famously said, "The most important thing to do if you find yourself in a hole is to stop digging." The dot-com companies for him were a hole of incomprehensibility. He couldn't project their cash flows, he couldn't identify a moat. So he put the entire sector into his too-hard pile. He was willing to look foolish. He was willing to miss out on what seemed like the easiest money ever made. He would rather miss a huge winner like Amazon than risk his shareholders' capital on a loser like Pets.com. When the bubble burst in 2000 and an estimated $5 trillion of market value evaporated, Buffett's discipline was vindicated in the most brutal way imaginable. His capital had been preserved. Those who had mocked him were financially ruined. His circle of competence, his refusal to play a game he didn't understand, had acted as an impenetrable shield, a perfect example of capital preservation through disciplined inaction. This wasn't luck, it was the result of a deeply ingrained mental framework, a framework that places the avoidance of catastrophic error above the pursuit of speculative gain. The psychological principle that Buffett's circle of competence so elegantly defeats is known as the Dunning-Kruger effect. Coined in 1999 by psychologists David Dunning and Justin Kruger, this cognitive bias describes a phenomenon where individuals with low ability in a specific domain tend to dramatically overestimate their own competence. In short, they are too ignorant to recognize their own ignorance. The world of investing is a perfect laboratory for the Dunning-Kruger effect. A novice investor reads a few articles about a revolutionary biotech company, learns a couple of industry buzzwords, and suddenly feels they have a deep insight into the complex world of clinical trials and molecular biology. They mistake a sliver of familiarity for genuine expertise. They see a stock chart going up and believe they understand the underlying business momentum. This overconfidence leads them to make high-risk bets with money they cannot afford to lose, operating far outside any rational boundary of knowledge. They don't know what they don't know, and that is the most dangerous position for an investor. Buffett's entire philosophy is a structured, lifelong rebellion against this bias. The circle of competence is an act of profound intellectual humility. It is a pre-commitment to honesty. It forces him to ask not, "What do I think I know?" but "What do I know with such certainty that I am willing to bet a significant portion of my net worth on it?" This question immediately exposes the vast chasm between casual familiarity and true, deep understanding. This is the mindset of an intelligent investor. It's not about being the smartest person in the room. It's about being the most self-aware. By clearly delineating what is inside his circle, simple, predictable businesses, he is simultaneously creating a map of his own ignorance. Everything else, from complex derivatives to speculative technology to volatile commodities, is explicitly labeled as territory where he is unqualified to operate. This act of labeling prevents the Dunning-Kruger effect from ever taking root. He cannot become overconfident in an area he has already declared himself incompetent to judge. It's a mental firewall. This is a crucial element of stock market psychology. The market is a feedback machine that can be dangerously misleading. In a bull market, even the most foolish decisions can be rewarded with temporary profits, reinforcing a false sense of genius. The Dunning-Kruger investor who buys a speculative stock that triples believes their research was brilliant, when in reality, they were simply lucky. Buffett's method short-circuits this destructive feedback loop. Because he refuses to play the game in the first place, he is immune to the temporary validation of a lucky bet outside his expertise. His discipline ensures that his successes are based on skill and process, not chance, which is the only sustainable path for long-term wealth building. So how do you translate this profound concept into a practical tool for your own portfolio management? You must build and define your own circle of competence with the same rigor Buffett applies to his. This is not a theoretical exercise, it is a blueprint for action. The first step is to conduct a competence audit. This is a deep, honest self-interrogation. Take out a piece of paper or open a document and create two columns: inside the circle and outside the circle. Under inside the circle, list the industries, business models, and technologies that you understand on a granular level. The key here is that the knowledge must be earned. Did you work in the software industry for a decade? You probably have a real edge in understanding enterprise software companies. Are you a passionate hobbyist who has spent years studying the video game industry? You might be able to identify durable competitive advantages that Wall Street analysts miss. Do you own a small business and understand the nitty-gritty of retail logistics and customer acquisition costs? That is a legitimate area of competence. The source of the knowledge doesn't matter, but its depth does. Now for the more important column, outside the circle. Be ruthless. If you can't explain the science behind a biotech drug, the entire biotechnology sector goes on this list. If you don't understand the complex geology and political risks of mining operations, then mining stocks go on the list. If you cannot explain what a credit default swap is, then complex financial institutions are out. This list is your declaration of intellectual freedom. It frees you from the obligation of having an opinion on 99% of the market. The second step is to apply the three-layer test to any potential investment that seems to fall within your circle. This is a simple, powerful filter. For any company, you must be able to explain, in simple language a child could understand, three things. Layer 1. What does this company actually do to provide value to its customers? Layer 2. How, specifically, does it make money from that activity? Layer 3. What is its durable competitive advantage, its moat, that will protect it from competitors for the next 10 years? If you stumble on any of these three layers, if your explanation becomes vague or relies on jargon, the company immediately goes into the too hard pile. No exceptions. This isn't about being smart, it's about being honest. The final step is to formalize this process by mapping the perimeter. Your lists from the competence audit become a core part of your written investment policy statement. This is a document that governs your financial decision-making. It's a constitution for your portfolio. By writing it down, you make a commitment to yourself. turning a vague idea into a hard and fast rule. This simple three-step process, audit, test, and map, is the practical application of Buffett's greatest mental model. It is the first and most critical piece of infrastructure for anyone serious about how to invest, moving from gambling to a disciplined professional approach. The opposite of Buffett's focused, humble approach is the path walked by 99% of market participants, the path of the know-it-all investor. This individual operates under the delusion that to be a successful investor, one must have an opinion on everything. They are constantly scanning headlines, watching financial news, and jumping from one hot trend to the next. Their portfolio is a chaotic mishmash of asset classes they barely understand. A little cryptocurrency bought at the peak of a mania, a few shares of a meme stock that was trending on social media, a slice of a speculative biotech firm based on a promising headline, and an international ETF for a country whose politics and economy they couldn't begin to explain. They mistake broad diversification for intellectual laziness, a strategy they call not putting all your eggs in one basket, but which in practice means they don't know enough about any of the baskets to have real conviction. Their defining characteristic is a complete lack of a circle of competence. For them, the entire market is their playground. This approach is not just suboptimal, it is a recipe for financial disaster. The perfect illustration is the behavior of the average retail investor during the dot-com crash of 2000 to 2002. Millions of ordinary people, from doctors to teachers, poured their life savings into companies like Webvan, eToys, and Pets.com. Did they understand the brutal, low-margin economics of the grocery delivery business? No. Did they have a deep insight into the competitive landscape of online toy retail? No. They were buying a story, a dream, a ticker symbol attached to the new economy. They were operating miles outside of any conceivable circle of competence. When the crash came, they were exposed. They couldn't tell the difference between a temporary price dip and a fundamental business failure. Panicked and confused, they sold at the bottom, locking in catastrophic losses, some losing their entire retirement savings. The know-it-all doesn't just lose money, they lose their confidence and often swear off investing forever, missing the subsequent recovery and the long-term wealth-building power of the market. They blame the rigged game, when the fault lies entirely with their own refusal to admit the limits of their own knowledge. This is the antithesis of the intelligent investor, a cautionary tale about the perils of intellectual arrogance and the fatal allure of trying to know everything. The ultimate purpose of the circle of competence and the too hard pile is not academic, it is intensely practical and has a direct, quantifiable impact on your financial results. The connection is simple: capital preservation through error avoidance. Investing is a game of survival first and returns second. The legendary investor George Soros said, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." The too hard pile is a system designed to dramatically limit the possibility and the magnitude of being catastrophically wrong. Consider the brutal math of losses. If you have a $100,000 portfolio and you suffer a 50% loss, you are left with $50,000. To get back to your starting point, you don't need a 50% gain. You need a 100% gain. A single, massive mistake made outside your area of expertise can set you back years, even decades. The circle of competence is the ultimate risk management tool because it prevents you from making these unforced errors. By refusing to invest in businesses you don't understand, you are eliminating the single greatest source of portfolio-destroying mistakes. On a balance sheet, this discipline means you are only dealing with companies whose financial statements you can actually read and interpret with confidence. You can distinguish between real, sustainable earnings and accounting gimmicks. In a portfolio, this translates to lower volatility and smaller drawdowns during market downturns. While others are panicking over their speculative bets, your portfolio of well-understood, durable businesses weathers the storm. This isn't about timing the market. It's about owning businesses that are resilient to market timing. This principle of avoiding permanent capital loss is the cornerstone of all value investing. It is the financial bedrock upon which all future wealth is built. The too hard pile is not a limitation on your potential returns. It is the very mechanism that guarantees you will survive long enough to achieve them. It keeps your compounding machine running, protecting it from the fatal blow of a catastrophic mistake, ensuring your journey toward financial freedom remains on track. If the circle of competence is the map that defines the battlefield, then the greatest enemy you will face on that field is not a market crash or a bad economy. The enemy is a traitor within your own mind. It is a primal, powerful, and deeply human emotion, the fear of missing out. FOMO is the engine of speculation. It's the voice that whispers, "Everyone else is getting rich, and you're being left behind." It's the panic that sets in when you see a stock you don't own double in a month. This emotion has likely destroyed more capital than all the recessions in history combined. It short-circuits our rational brain, transforming a disciplined investor into a gambler chasing a hot streak. Buffett's too hard pile is not just an intellectual filter. It is a psychological shield, a pre-programmed defense against this insidious emotional attack. When an opportunity arises that is generating immense hype and excitement, but it falls outside your circle of competence, the too hard pile provides an immediate, non-negotiable off-ramp. You don't have to engage in a debate with your own emotions. You don't have to weigh the pros and cons. The decision has already been made by your rational, disciplined self. The rule is simple. If I don't understand it, I don't touch it. This act of immediate disqualification starves FOMO of the oxygen it needs to survive. You cannot fear missing out on something you have already decided you have no business participating in. This pillar is about recognizing that successful investing is not primarily an intellectual challenge. It is an emotional one. Mastering your own psychology is more important than mastering financial models. Conquering FOMO is the key to unlocking the long-term, patient approach that true wealth building requires. A powerful illustration of Buffett's immunity to FOMO is the story of Berkshire Hathaway's acquisition of See's Candies in 1972. At the time, the hot investments were the Nifty 50, a group of large-cap growth stocks like Polaroid, Xerox, and IBM that were considered so good you could buy them at any price. The market was euphoric about these companies, and their valuations soared to extreme levels. This was the FOMO trade of the era. Buffett ignored it completely. Instead, he and Charlie Munger found See's Candies, a family-owned chocolate company on the West Coast. There was nothing glamorous about it. It wasn't a world-changing technology. It was a simple, boring business. They entered into negotiations with the See family, who wanted $30 million for the company. Buffett, still heavily influenced by his mentor Benjamin Graham's strict cigar-butt value investing style, calculated the company's tangible assets, its factories, its inventory, and came up with a much lower number. His analysis said the business was worth no more than its book value, and he was initially unwilling to pay the premium the family was asking. This is where Charlie Munger's influence was critical. Munger convinced Buffett that he was missing the true value of the business, its intangible asset, the brand. See's had immense pricing power. Customers loved the product and were willing to pay a little more for it year after year. The brand was a powerful moat that wasn't visible on the balance sheet. Buffett, after much debate, relented, and they purchased the company for $25 million. This was a pivotal moment in his career. It was a move away from buying mediocre companies at cheap prices to buying wonderful companies at fair prices. But notice what the decision was based on: a deep, fundamental understanding of the business, its brand, and its customers. It had nothing to do with market sentiment or what other investors were doing. He wasn't chasing the Nifty 50. He was buying something he understood inside and out, a business that was firmly within his circle of competence. See's Candies has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, requiring very little additional capital investment. It was an initial investment that has paid for itself 80 times over. While the FOMO-driven investors of the Nifty 50 era were decimated in the subsequent crash of 1973-74, with many of those can't-miss stocks falling by over 80%. Buffett's boring little candy company just kept churning out cash. This anecdote is the perfect antithesis to FOMO. It demonstrates a core principle of his investment strategy. Ignore the noise, ignore the crowd, and focus with monastic intensity on the simple, understandable economics of a business. That is how you build lasting wealth. The reason FOMO is such a potent portfolio killer is because it hijacks deep-seated psychological wiring in the human brain. The two primary mechanisms at play are herd mentality and the principle of social proof. Humans are social creatures. For millennia, our survival depended on our ability to stick with the tribe. Being cast out from the group was a death sentence. This evolutionary pressure has hardwired us to follow the crowd. When we see a large group of people doing something, whether it's running from a predator or buying a particular stock, our instinct is to assume they know something we don't and to follow along. This is herd mentality. In the stock market, this instinct is almost always wrong. The herd is notoriously fickle, stampeding into assets at the peak of euphoria and selling in a panic at the bottom of a crash. Social proof is a related concept. It's the tendency to find an action more appropriate or correct when we see others doing it. When your friends, your colleagues, and the experts on TV are all celebrating the money they're making on a hot new tech stock, the social proof is overwhelming. Your brain's internal monologue says, if all these smart people are buying it, it must be a good idea. This is a cognitive shortcut that saves us from having to do our own difficult, independent thinking. The problem is that in investing, consensus is often the enemy of returns. By the time an investment is popular enough to generate widespread social proof, the price is often already inflated, and the best returns have already been made. The neuroscience behind this is fascinating. When we participate in a winning trend with the herd, our brains release dopamine, the same neurotransmitter associated with reward and pleasure. It feels good to be part of the winning team. Conversely, when we are on the sidelines watching everyone else get rich, our amygdala, the brain's fear center, lights up. This triggers a primal fear of being left behind, of exclusion from the tribe's prosperity. This is the biological reality of FOMO. It is not a character flaw, it is a feature of our evolutionary design. This is why a logical system like the two-hard pile is so essential. It acts as a pre-commitment, a rational circuit breaker installed during a moment of calm that can override the powerful, irrational emotional impulses that arise in the heat of a market mania. It is the triumph of the logical prefrontal cortex over the fearful amygdala. Understanding this stock market psychology is the first step toward conquering it, creating the financial discipline necessary to ignore the herd and forge your own path. To systematically defeat FOMO, you need a tool that forces a moment of reflection and creates a record of your emotional impulses. This tool is the Anti-FOMO Decision Journal. It is a simple but profoundly effective mental model for building financial discipline. Here is the blueprint. First, get a physical notebook or create a dedicated digital document. The next time you feel that powerful urge to buy a hot stock, a stock you heard about on the news, from a friend, or on social media, you must stop. Before you even log into your brokerage account, you open your journal. This is the first and most critical step, creating a pause between stimulus and response. Second, at the top of a new page, write down the name of the stock and the date. Then, you must deconstruct the emotion. Ask yourself a series of brutally honest questions and write down the answers. Why do I want to buy this? Is it because I have spent 10 hours reading its annual reports and I deeply understand its competitive advantage? Or is it because my cousin just made 50% on it and I feel like an idiot for missing out? Is my thesis based on a durable business model or on the hope that the price will continue to go up because it has been going up? This process forces you to confront the true driver of your decision. Is it logic or emotion? Third, you apply the strict circle of competence test. Can you explain to a fifth grader what this business does, how it makes money, and why it will still be winning in 10 years? If the answer is no, you write in big letters next to the stock's name, "Too hard pile." The decision is made. You close the journal and you do not buy the stock. The final step is what makes this tool so powerful. You create a ghost portfolio. Even though you didn't buy the stock, you will track its outcome. Make a note of the price on the day you entered it into your journal. Then, set a calendar reminder for 3 months, 6 months, and 1 year later. When the reminder goes off, you go back to your journal entry and write down the stock's current price. This creates a personal, undeniable feedback loop. Over time, you will build a written record proving that the vast majority of your FOMO-driven impulses, if acted upon, would have led to significant losses. You will see firsthand that the hot stock of today is often the forgotten loser of tomorrow. This journal becomes your personal evidence, reinforcing the wisdom of your discipline and making it easier and easier to say no the next time the siren song of FOMO begins to play. This is a practical step-by-step guide on how to invest with rationality, not emotion. The path of the 99% is the path of the momentum chaser. This investor's strategy, if you can call it that, is to buy what is going up and sell what is going down. They have no underlying business thesis. Their only guiding principle is the direction of the stock chart. They are a leaf in the wind of market sentiment, constantly chasing performance and always arriving late to the party. Their entire approach is a manifestation of FOMO. They are terrified of missing the upward trend, so they pile in, often near the peak, and they are terrified of further losses, so they sell in a panic during a downturn, often near the bottom. This behavior is the exact opposite of the value investing principle of being greedy when others are fearful and fearful when others are greedy. The most vivid recent example of this phenomenon was the mania surrounding the ARK Innovation ETF, known as ARKK, during 2020 and early 2021. The fund, led by a charismatic portfolio manager, invested in disruptive, futuristic technology companies. Its performance was staggering. In 2020 alone, it returned nearly 150%. The story was intoxicating, the gains were hypnotic, and the social proof was overwhelming. A massive herd of retail investors, driven by an intense fear of missing out on the future, poured billions of dollars into the fund. They didn't understand the complex technologies of the underlying holdings, like genomics or autonomous driving. They certainly didn't understand the sky-high valuations of these often unprofitable companies. They were buying a hot hand and a good story. They were chasing momentum. Then, in early 2021, the tide turned. As interest rates began to rise, the market's appetite for speculative, long-duration assets collapsed. The ARKK ETF began a precipitous decline, eventually falling nearly 80% from its peak. The momentum chasers who had piled in near the top were financially annihilated. They had bought the hype and were left holding the bag. The too hard pile would have saved them. A simple, honest assessment. Do I truly understand the science of CRISPR gene editing or the competitive landscape of electric vehicle battery technology? Would have led to the inevitable conclusion that these investments were outside their circle of competence. They were a gamble, not an investment. And the momentum chaser paid the price for failing to recognize the difference. This is a timeless lesson in risk management. Chasing performance is a losing game. The direct financial connection between conquering FOMO and building wealth is profound and twofold. It protects you from buying at peak valuations, and it prevents the winner's curse. FOMO is at its most powerful when an asset is making headlines, when its price has already experienced a massive run-up. This is the point of maximum public excitement, and almost always the point of maximum financial risk. By systematically placing these hyped-up, difficult-to-understand assets into your too-hard pile, you are automatically building a defensive wall against buying at the top of a bubble. This has a direct and quantifiable impact on your portfolio's performance. Your average purchase price across all your investments will be inherently more rational and disciplined. You will be buying businesses based on their intrinsic value, not on their popularity, which is the only sustainable way to generate long-term returns. The second financial benefit is avoiding what's known in auction theory as the winner's curse. In a competitive bidding situation, the winner is often the person who most overestimates the value of the asset. The stock market is a giant auction. When a hot story stock is rocketing upwards, a bidding war ensues. The investors driven by FOMO are the ones willing to pay any price, to bid higher and higher, just to get in on the action. The person who finally wins, who buys the shares at the peak, is often the biggest loser in the long run. They are cursed by their victory, having paid a price that makes a positive return almost impossible. The too hard pile is a discipline that forces you to walk away from these auctions. It ensures that you only participate in situations where you have a clear analytical advantage and can purchase an asset for significantly less than your conservative estimate of its intrinsic worth. This disciplined approach to pricing is a cornerstone of effective portfolio management. By refusing to overpay, you build a margin of safety into every investment you make. This margin of safety is what protects your downside and provides the fuel for your upside, creating a much more favorable and asymmetric risk-reward profile for your entire wealth-building journey. In a culture that celebrates hustle and constant action, the most powerful and counterintuitive strategy for building wealth is often disciplined inaction. The investing world is filled with noise that encourages activity. Buy this, sell that, rebalance now. The financial media thrives on a sense of urgency. But the truth is, most of this activity is not only unnecessary, it's destructive to your returns. Every decision you make is a potential point of failure. Warren Buffett's too hard pile is a system designed to drastically reduce the number of decisions you have to make. By immediately dismissing 99% of the investment universe, you are freed from the burden of analyzing it, worrying about it, or acting on it. This elevates inaction from a passive state to a powerful, strategic choice. It is the conscious decision to conserve your two most precious resources, your capital and your mental energy. You are waiting, patiently, for the perfect pitch, the one opportunity that is so good, so clear, and so well within your circle of competence, that it would be a mistake not to act. This is a profound shift in mindset. You stop being a frantic speculator trying to catch every market ripple and become a patient capital allocator, waiting for the fat pitch down the middle of the plate. This pillar explores how this disciplined refusal to act, this strategic patience, is the secret weapon of the world's greatest investors and the key to preserving and compounding capital over the long term. The ultimate test of Buffett's commitment to strategic inaction came in the fall of 1998, during the collapse of the hedge fund Long-Term Capital Management, or LTCM. This was not some fly-by-night operation. LTCM was a dream team of financial superstars, including two Nobel Prize-winning economists. They had developed incredibly complex, supposedly infallible mathematical models to exploit tiny pricing inefficiencies in the global bond markets. They believed they had eliminated risk. To amplify their tiny returns, they used staggering amounts of leverage, borrowing over $100 for every dollar of their own capital. For a few years it worked brilliantly, but in August 1998, after Russia defaulted on its debt, their models broke. The once-in-a-million years event happened, and the fund began to hemorrhage money at a catastrophic rate, losing hundreds of millions of dollars a day. The entire global financial system was at risk. The Federal Reserve of New York, fearing a domino effect of collapse, organized a desperate, weekend-long bailout meeting with the heads of the major Wall Street banks. And they called Warren Buffett. He was seen as the only one with the capital and the credibility to potentially solve the crisis. Buffett analyzed the situation. He saw a portfolio of tens of thousands of complex derivative positions that no one fully understood. He recognized the panic and the fear. Instead of joining the complicated bailout consortium the Fed was trying to assemble, he made his own, brutally simple offer. He offered to buy the entire toxic portfolio for a mere $250 million and inject $3.75 billion of his own capital, but only on his own terms. His offer was a take-it-or-leave-it proposition with a very short deadline. He didn't need to do the deal. Berkshire Hathaway was safe and sound. He was acting from a position of immense strength. a strength built on decades of patient capital preservation. In the frantic chaos of the negotiation, the deal fell through over a minor detail, and Buffett simply walked away. He said no. He didn't get caught up in the drama or the ego of being the savior of Wall Street. His disciplined inaction protected him from diving into a complex, chaotic situation he couldn't fully control. While the Wall Street banks were forced to act, cobbling together a messy, multi-billion-dollar bailout to save their own skins, Buffett sat calmly in Omaha, his capital untouched. This is the power of inaction. It is the freedom to say no, even when the entire world is screaming at you to do something. It is the ultimate expression of financial independence and a core tenet of his CEO mindset. The psychological force that Buffett's discipline of inaction masterfully counters is known as action bias. This is the innate human tendency to favor action over inaction, even when inaction is the more logical and beneficial choice. We are wired to believe that doing something is always better than doing nothing. In our evolutionary past, this bias was a survival mechanism. If you heard a rustle in the bushes, it was better to run, action, than to stand still and analyze the situation, inaction. But in the modern world of investing, this instinct is a devastating liability. Action bias manifests in the constant need to tinker with a portfolio. An investor feels they must react to every news story, every earnings report, every market gyration. They sell a stock that's down slightly to cut their losses. They buy a stock that's up to ride the momentum. This constant churning feels productive. It provides a sense of control. But it is an illusion. More often than not, it leads to buying high, selling low, racking up transaction costs, and making emotional decisions. The too-hard pile is a powerful antidote to action bias. It creates a system where the default setting is no, the default is inaction. By predefining the vast majority of the market as off-limits, it removes the temptation to act on things you don't understand. It forces you to overcome a much higher hurdle to justify taking any action at all. This institutionalizes patience. It transforms doing nothing from a sign of laziness or indecision into a strategic position of strength. You are not simply waiting. You are actively and deliberately choosing not to engage until an opportunity of truly exceptional quality presents itself. This shift requires immense financial discipline, as it goes against our very nature, but it is essential for long-term success. It's about understanding that in investing, you are paid for the quality of your decisions, not the quantity. By embracing inaction, you save your decision-making firepower for the very few moments where it truly counts. To operationalize the power of inaction, Buffett and Munger have often used a powerful mental model, the 20-slot punch card rule. This is a blueprint you can use to transform your own investment decision-making from a frantic activity into a deliberate, high-stakes process. Here's how it works. Imagine that at the beginning of your investing life, you are given a punch card with only 20 slots on it. These 20 punches represent the total number of investments you are allowed to make in your entire lifetime. Once you've made 20 investments, you can't make any more. Every single time you consider buying a stock, you must ask yourself, is this opportunity so good? Is my conviction so high that I am willing to use one of my precious, non-replaceable 20 punches on it? This mental framework has a profound and immediate effect on your behavior. It dramatically raises your standards. You are no longer looking for pretty good ideas. You are no longer interested in speculative flyers or mediocre maybes. You are forced to hunt for absolute certainties, the no-brainer opportunities that you understand so deeply and that are priced so attractively that you would feel foolish not to invest. The 20-slot punch card forces you to do the hard work. You can't just buy something based on a tip or a headline. To justify using one of your lifetime slots, you must conduct deep research, understand the business inside and out, and have unshakable conviction in its long-term prospects. This naturally makes you say no to 99.9% of the ideas that cross your desk. The too-hard pile becomes your best friend. because it quickly filters out the thousands of companies that are not worthy of one of your punches. This model also encourages a long-term mindset. If you only have 20 slots, you are not going to waste one on a short-term trade. You are going to make every decision with the intention of holding that business for years, if not decades, allowing the power of compounding to work its magic. Adopting the 20-slot punch card rule is one of the most effective ways to cultivate the CEO mindset. It forces you to think like a capital allocator, not a stock trader. It instills a level of discipline and patience that is almost impossible to achieve otherwise, ensuring that every yes is a high-conviction, well-reasoned decision, dramatically improving your odds of successful wealth building. The antithesis of the patient, punch card-wielding investor is the hyperactive trader. This is the path of the 99%. The hyperactive trader is addicted to action. Their phone is a constant source of market quotes and news alerts. They see investing as a fast-paced video game, where the goal is to be constantly moving, buying, and selling. Their portfolio is in a state of perpetual churn. They might buy a stock in the morning because of a positive analyst report and sell it in the afternoon because of a rumor on a message board. They mistake this frantic activity for progress and sophistication. They believe they are being vigilant, that they are managing their money. In reality, they are their own worst enemy. Study after study, most notably DALBAR's annual quantitative analysis of investor behavior, has shown that the average retail investor's portfolio massively underperforms simple, unmanaged index funds. The primary reason for this underperformance is not poor stock picking, it's poor timing driven by hyperactivity. They consistently buy after prices have risen and sell after they have fallen, a direct result of their action bias and emotional decision-making. The hyperactive trader is not just fighting the market, they are fighting a war of attrition against themselves. Every trade they make incurs a small cost, a commission, a bid-ask spread, that acts as a tiny leak in their financial boat. Over hundreds of trades, these small leaks can sink the entire vessel. They are also waging a losing battle against taxes. By constantly selling winning positions, they are triggering short-term capital gains which are taxed at a much higher rate than long-term gains. They are voluntarily giving a huge chunk of their profits to the government, crippling the compounding process before it can even begin. The hyperactive trader is a perfect example of someone who has rejected the concept of a too hard pile. To them, nothing is too hard. They have an opinion on everything and are willing to act on any impulse. The result is a portfolio built on sand, constantly shifting and eroding, a tragic testament to the destructive power of undisciplined action. The direct financial connection between strategic inaction and wealth building is one of the most powerful forces in finance. The minimization of transaction costs and tax drag. These two seemingly small factors are silent killers of long-term returns, and Buffett's buy and hold forever philosophy, fueled by his rejection of constant activity, is designed to neutralize them completely. First, let's consider transaction costs. While commissions have come down, there is still a cost to every trade in the form of the bid-ask spread, the small difference between the price you can buy a stock for and the price you can sell it for at any given moment. For the hyperactive trader, these small costs add up to a significant and guaranteed loss over time. It's like paying a small entry fee every time you step into the casino. The house always wins. By adopting a strategy of extreme inaction, you might only make 1 or 2 trades in a year, or even a decade. Your transaction costs effectively round down to zero, meaning all of your capital is working for you, not for your broker. The far more significant impact, however, is on taxes. This is a concept that most beginners in investing fail to appreciate. Let's say you invest $10,000 and it doubles to $20,000 over a year. A hyperactive trader, eager to lock in their gain, sells the stock. They now have a $10,000 short-term capital gain, which in the United States could be taxed at a rate as high as 37%. They immediately lose $3,700 of their profit to the IRS. A disciplined, inactive investor like Buffett would simply do nothing. Their $20,000 remains invested, with the full amount continuing to compound. The tax is deferred indefinitely. By holding a great business for decades, you are essentially receiving an interest-free loan from the government on your deferred tax liability, allowing that money to compound on your behalf. This tax drag is the single biggest and most overlooked advantage of a long-term, low-turnover investment strategy. The too-hard pile and the 20-slot punch card rule are the mechanisms that enforce this discipline. By making you say no to almost everything, they ensure that when you finally do say yes, it's to a business you intend to own for a very long time. This is how you transform your portfolio from a tax-inefficient trading vehicle into a powerful, tax-efficient compounding machine, dramatically accelerating your path to financial freedom. In the world of investing, there is a dangerous allure to complexity. Intricate strategies, jargon-filled analysis, and sophisticated financial products can create an illusion of intelligence and control. Wall Street is built on this illusion, selling complexity because it is easier to charge high fees for something that seems complicated and mysterious. Warren Buffett's philosophy is a radical rebellion against this trend. His fourth pillar is the simplicity mandate, the unwavering belief that the most profitable and durable investments are found in simple, understandable businesses. Complexity, in his view, is not a sign of sophistication. It is the enemy of profit and the breeding ground for catastrophic mistakes. If a business model is so convoluted that it requires a PhD in finance to understand, it's likely hiding weaknesses or is simply too unpredictable to be a reliable long-term investment. The too-hard pile is the ultimate filter for complexity. It automatically discards any business that cannot be easily and simply explained. This doesn't mean the business is bad, it just means it is unknowable for the investor. This mandate for simplicity is not about dumbing down the investment process. It's about focusing on the few powerful variables that truly drive long-term value, rather than getting lost in the noise of 100 minor ones. It's the recognition that you don't need to be a genius to be a successful investor. You just need to be rational, disciplined, and honest about what you can and cannot understand. This pillar is about clearing away the fog of complexity to see the clear, simple reality of a business's economic engine. One of the most defining investments of Buffett's career and a perfect embodiment of the simplicity mandate was his massive purchase of Coca-Cola stock starting in 1988. The context is crucial. The market had just been rocked by the Black Monday crash of October 1987, and fear was rampant. Investors were selling indiscriminately. In this environment of panic, Buffett wasn't looking for a complex turnaround story or a speculative bet on a new technology. He was looking for certainty and simplicity, and he found it in a can of soda. Over the next several months, he invested over $1 billion, at the time, a huge portion of Berkshire Hathaway's portfolio, into the Coca-Cola Company. On the surface, it was a shockingly simple, even boring decision. What was the business model? Coca-Cola takes sugar, water, and secret syrup, mixes them together, and sells the resulting beverage through a massive global distribution network. That's it. There was no complex technology to analyze, no confusing patent portfolio to decipher. The business could be understood by anyone. But beneath this simplicity lay a fortress of economic power. Buffett saw a company with a brand that was arguably the most valuable in the world, a name recognized in every corner of the globe. This brand created a moat in the minds of consumers, allowing Coke to consistently charge a premium price. He saw an incredibly simple and predictable human behavior. People enjoy sweet, caffeinated beverages, and they had been enjoying them for 100 years. He could predict with a very high degree of certainty that people would still be drinking Coke in 10, 20, or even 50 years. He famously said he wanted to buy businesses with such strong competitive advantages that even an idiot could run them, because sooner or later, one would. Coca-Cola was that business. He didn't need a complex spreadsheet to value it. He needed to understand the simple, durable power of its brand and its business model. This investment was a direct rejection of the complexity that was fashionable at the time. while others were dabbling in portfolio insurance and complex arbitrage strategies that ultimately failed. Buffett was making one of the biggest bets of his life on sugar water. The result? The investment was a home run, generating billions in dividends and capital gains for Berkshire shareholders, and it remains a core holding to this day. It is the ultimate proof that the greatest profits are often found in the simplest ideas. The human brain is susceptible to a powerful cognitive trap known as complexity bias. This is the tendency to give undue credence to complex concepts over simple ones. We often assume subconsciously that a complex solution is a more intelligent or effective one. A doctor who gives you a complicated, multi-step diagnosis with lots of medical jargon might seem more credible than one who simply says, "You have a common cold, go home and rest." In investing, this bias is rampant and dangerous. Wall Street sells complexity because it justifies high fees and creates an information asymmetry between the experts and the average person. Investors are drawn to convoluted investment products like collateralized debt obligations or leveraged ETFs because they feel sophisticated and exclusive. They believe that by grappling with this complexity, they are gaining an edge. This often ties into another bias, the illusion of control. By engaging with intricate charts, technical indicators, and complex financial models, an investor can feel like they are in control of an inherently uncertain future. It provides a comforting sense of agency. The reality is that this complexity is often a veil that obscures a lack of real substance, or, worse, conceals enormous hidden risks. Buffett's too-hard pile is a systematic defense against both of these biases. By demanding radical simplicity, requiring that a business be understandable to a fifth grader, he is short-circuiting the brain's natural attraction to complexity. He is forcing himself to ground every investment decision in observable reality, not in abstract theories or black box models. This is a crucial component of his stock market psychology. He understands that a key to long-term survival is avoiding situations where you can be fooled by randomness or misled by hidden variables. Simple businesses have fewer moving parts, making them easier to analyze and their futures easier to predict. By rejecting complexity, he is not sacrificing intelligence. He is embracing a higher form of it. The wisdom to know that true genius lies in making the complicated simple, not the other way around. To instill the simplicity mandate into your own investment process, you can use a powerful and practical mental model, the explain it to a fifth grader test. This is a simple, non-negotiable filter that will protect you from the dangers of complexity. The blueprint is straightforward. Before you even consider investing a single dollar in a company, you must perform this test. The first step is to find a fifth grader. If you don't have one handy, you can imagine one in vivid detail. This is your audience. They are intelligent, but have no specialized business or financial knowledge. The second step is to pitch the investment to them. You must explain in the simplest possible terms 3 things. First, what does the company sell, and why do people buy it? Second, how does the company make money from this? And third, what is the company's superpower, its moat, that stops other companies from coming in and taking all their customers? The final step is the verdict, and it is brutally objective. Does the fifth grader understand you? Can they repeat the core of your explanation back to you in their own words? If the answer is yes, the business has passed the simplicity test and may be a candidate for further research. However, if you find yourself stumbling, if you have to use industry jargon, if you start talking about synergistic platforms, downstream integration, or non-GAAP earnings adjustments, you have failed the test. The business is too complicated. It goes directly into the too hard pile. No appeals, no exceptions. This test is so effective because it forces you to cut through the corporate buzzwords and the Wall Street narrative and get to the fundamental economic reality of the business. If you cannot explain it simply, it is a glaring sign that you do not truly understand it yourself. This is a core practice for any intelligent investor, a discipline that helps you avoid the seductive trap of complexity and ensures that your portfolio is built on a foundation of businesses you can genuinely comprehend. This simple filter is one of the most effective risk management tools you can ever employ. The path of the 99% is often the path of the sophisticated investor. This individual is not content with simple ideas. They believe their intelligence and education entitle them to superior returns, and they seek out complexity as a way to prove it. They are drawn to the esoteric corners of the financial world, believing that is where the real alpha is hidden. They might invest in a hedge fund with a black box quantitative strategy they don't understand, attracted by the impressive credentials of its managers. They might trade complex options strategies with names like iron condors or straddles, mesmerized by the seemingly infinite possibilities but blind to the embedded risks. They might purchase private equity funds, lured by the promise of high returns, without fully grasping the convoluted fee structures, the illiquidity of the investment, and the use of extreme leverage that juices the reported numbers. The ultimate and most tragic example of this pursuit of sophistication leading to ruin was the lead-up to the 2008 financial crisis. Millions of investors, including large, supposedly sophisticated institutions like pension funds and banks, bought trillions of dollars worth of mortgage-backed securities and collateralized debt obligations, CDOs. These were incredibly complex financial instruments, created by slicing and dicing thousands of individual mortgages into different tranches of risk. The mathematical models used to price them were so complex that almost no one, not even the people who created them, truly understood their underlying vulnerabilities. But they were sold as a sophisticated, high-yielding, and safe alternative to simple bonds. Investors abdicated their own judgment, trusting the credit ratings agencies and the complex models. They embraced complexity and were rewarded with the near-total collapse of the financial system. This is the ultimate cautionary tale. The pursuit of sophistication is often a cover for a lack of common sense. The sophisticated investor scoffs at the idea of buying Coca-Cola, dismissing it as too simple. Yet it is that very simplicity that provides the durability and predictability that protects capital, while their complex bets are the ones that are most likely to blow up when faced with the harsh reality of an unpredictable world. The direct financial connection between the simplicity mandate and your portfolio's health is all about the predictability of cash flows and the avoidance of a hidden, quote, complexity premium. Simple, understandable businesses, the kind Buffett loves, tend to have one thing in common. Their future earnings are relatively easy to forecast within a reasonable range. A company like See's Candies has a long history of steady demand and pricing power. You can look at its financial statements and project its cash flows for the next 5 to 10 years with a much higher degree of confidence than you could for, say, a biotech company whose entire future rests on the outcome of a single clinical trial. This predictability is golden for an investor. It dramatically reduces the risk of overpaying for an asset. When you can confidently estimate future cash flows, you can arrive at a much more reliable estimate of a company's intrinsic value. On a company's balance sheet and income statement, this simplicity manifests as clarity. You can easily see where the revenue comes from, what the true costs are, and how much cash is left over for the owners. There is less room for accounting tricks or obfuscation. In your portfolio, this translates directly to a lower risk profile. You are not unknowingly paying a complexity premium, the extra amount the market often charges for assets with exciting but uncertain stories. Instead, you are buying a tangible, predictable stream of future cash at a reasonable price. This is the absolute essence of value investing. By filling your portfolio with these simple, cash-gushing machines, you are not limiting your upside. You are building a robust foundation for wealth building. You are ensuring that your returns are generated by the underlying performance of the businesses you own, not by speculative fervor or your ability to decipher complex financial engineering. This is the path to achieving genuine, long-term financial freedom. The final pillar of Buffett's too-hard-pile philosophy is the ultimate result of the first four. When you have defined your circle of competence, conquered FOMO, embraced inaction, and demanded simplicity, you are left with a powerful and scarce resource: focus. The too-hard pile is a giant filtration system that removes 99% of the noise, the distractions, and the mediocre opportunities from your field of vision. This allows you to dedicate 100% of your intellectual and financial capital to the handful of truly exceptional opportunities that remain. This is the compounding of focus. Just as money compounds over time, the benefits of focused attention compound as well. Instead of knowing a little bit about 100 different companies, you can aim to know almost everything about 5 or 10. This deep, specialized knowledge is your ultimate competitive advantage as an investor. It allows you to see value where others don't, and to act with decisive conviction when the market offers you a rare and wonderful price. This pillar is about shifting from a strategy of broad, superficial diversification to one of concentrated, high-conviction conviction. It's the understanding that true risk management comes not from owning a tiny piece of everything, but from deeply understanding the few things you do own. This is the final and most powerful step in transitioning from a passive market participant to a dominant, intelligent investor. The principle of concentrated focus was forged in the early days of Buffett's career, long before Berkshire Hathaway became a household name. In the 1960s, he ran the Buffett Partnership, a small investment fund for family and friends. It was here that he perfected his aggressive, focused style. The most legendary example was his investment in American Express in 1964, following the salad oil scandal. One of American Express's major clients, a company that dealt in salad oil, was discovered to be a massive fraud. They had been borrowing huge sums of money against tanks supposedly full of salad oil, but the tanks were mostly full of water. When the fraud was exposed, the company went bankrupt, and it looked like American Express, which had guaranteed the loans, would be on the hook for devastating losses. The market panicked. Wall Street assumed American Express was ruined, and its stock price was cut in half. This was a moment of intense fear and uncertainty. But for Buffett, it was an opportunity. Instead of relying on headlines, he did the work. He went out to restaurants and banks in Omaha. He talked to merchants and travelers. He observed that people were not stopping using their American Express cards or travelers' checks. The fear was on Wall Street, not on Main Street. He realized that the scandal had not damaged the fundamental franchise, the powerful brand and trust that American Express had built with its customers. He concluded that the company could easily absorb the losses, and that the market's reaction was wildly irrational. Armed with this deep, focused insight, he didn't just take a small position, he acted with overwhelming force. He invested 40% of the entire partnership's capital into American Express stock. This was an act of extreme concentration. It was a bet that would have destroyed a lesser investor if they were wrong. But Buffett wasn't guessing. His focused research had given him a degree of certainty that was miles beyond that of the average market participant. The too hard pile is what made this possible. By saying no to hundreds of other potential investments, he had conserved his capital and, more importantly, his mental bandwidth, allowing him to go all in. When he finally found an opportunity that was a perfect fit, the investment was a spectacular success. The stock quintupled in the following years, generating enormous returns for his partners. This is the power of the compounding of focus, the ability to ignore the universe of maybes to make a massive, decisive bet on a single, well-understood certainty. The psychological enemy of focus is decision fatigue. This is a well-documented psychological phenomenon which states that the quality of a person's decisions deteriorates after a long session of decision-making. The human brain, much like a muscle, has a finite amount of energy for high-quality cognitive tasks. Each decision you make, no matter how small, depletes this energy reserve. An investor who forces themselves to have an opinion on every stock, to follow every market trend, and to analyze every economic data point, is subjecting themselves to an overwhelming barrage of decisions. They are constantly asking, should I buy this? Should I sell that? Is this news good or bad for my portfolio? By the end of the day, their brain is exhausted. This is when they are most vulnerable to making poor, impulsive choices. They might sell a good company during a panic or buy a speculative stock on a whim, simply because they no longer have the mental energy to adhere to their own disciplined process. The too hard pile is perhaps the most effective productivity hack ever invented for an investor, because it is a system designed to prevent decision fatigue before it can even start. By preemptively and permanently eliminating 99% of the investment universe from consideration, Buffett drastically reduces the number of decisions he needs to make. He doesn't waste a single calorie of mental energy thinking about biotech or cryptocurrency, or the latest social media IPO. That cognitive energy is preserved and conserved for the one or two big decisions he might have to make in a year. When a true opportunity arises within his circle of competence, he can approach it with a mind that is fresh, clear, and fully capable of deep, rational analysis. This is a profound competitive advantage. While other investors are frazzled and exhausted from chasing every piece of news, Buffett is calm and focused, his mind a finely honed weapon, ready to be deployed with maximum effectiveness when it matters most. He is playing a different game, a game where the preservation of cognitive resources is as important as the preservation of capital. To implement the compounding of focus in your own life, you need a mental model that forces you to ruthlessly cull your commitments and concentrate on what truly matters. This blueprint is the Personal Board of Directors framework. It's a method for transforming your portfolio from a random collection of stocks into a concentrated group of elite businesses that you know inside and out. The first step is to conduct a portfolio cull. Look at every single holding in your portfolio right now, from individual stocks to mutual funds and ETFs. For each one, ask yourself this brutal question: knowing what I know today, would I enthusiastically invest new money into this position at its current price? If the answer is anything less than a resounding, unequivocal yes, that position becomes a candidate for selling. This includes the maybes, the I'll wait and see, and the ones you're holding just to get back to even. Be ruthless. The goal is to clear the deck of mediocrity. The second step is to build your board. The handful of positions that remain after the cull are your new core portfolio. These are your board of directors. You should think of yourself not as a shareholder, but as a board member of these few elite companies. This implies a new level of responsibility. You should know these businesses so well that you could intelligently participate in a board meeting. You should read their annual reports not as a chore, but with the genuine interest of an owner getting an update from their management team. You must understand their strategy, their competitive landscape, and their capital allocation decisions. The final step is the focus mandate. Your primary job as an investor is no longer to constantly search for new ideas. Your job is to become the world's leading expert on your 5 to 10 board member companies. This fundamentally shifts your perspective and your daily activities. You stop being a frantic stock picker and become a disciplined business owner. This intense focus gives you the conviction to hold on during market downturns, and, more importantly, the wisdom to buy more of your great companies when the market offers them to you at a discount. The Personal Board of Directors framework is the ultimate application of the entire too hard pile philosophy. It is the end result of a rigorous process of elimination, leaving you with a concentrated portfolio of understandable, high-quality businesses that you can confidently own for the long term. This is how you move from a strategy of hope to a strategy of knowledge. The antithesis of the focused, concentrated investor is the diversifier. This is the path of the 99%, an approach born from a misunderstanding of the true nature of risk. The diversifier believes that safety comes from owning as many different things as possible. Their portfolio is a sprawling, chaotic collection of hundreds of individual stocks, dozens of mutual funds, and a grab bag of ETFs covering every conceivable sector and geography. They proudly proclaim that they are diversified, but what they have actually achieved is a state of guaranteed mediocrity. By owning a tiny piece of everything, they have ensured that the performance of their best ideas will be hopelessly diluted by the performance of their worst ones. Their portfolio is so complex and sprawling that they cannot possibly understand what they own. They are owners of tickers, not businesses. They have outsourced their thinking to the market average. This approach is often promoted by the financial industry because it feels safe and responsible. But it is a trap. The diversifier has not eliminated risk. They have simply exchanged one type of risk for another. They have traded the risk of being catastrophically wrong about a single company, a risk that can be managed through deep research, for the certainty of never being meaningfully right about anything. They are destined to achieve, at best, the average market return, minus the fees and expenses they pay for their myriad of funds. They have put a permanent ceiling on their own potential for wealth building. The diversifier's mistake is confusing ignorance with safety. True risk management, as Buffett has proven for over 60 years, comes from knowledge. It comes from the deep, focused understanding of a few great businesses. The diversifier, by spreading their capital and their attention so thin, has condemned themselves to a state of permanent ignorance, forever adrift in the sea of market noise, never able to harness the life-changing power of concentrated conviction. The ultimate financial advantage of the compounding of focus is its direct connection to the generation of alpha. In the language of portfolio management, alpha is the holy grail. It represents the excess return of an investment relative to a benchmark index. It is a mathematical measure of skill. If the S&P 500 returns 10% in a year, and your portfolio returns 15%, you have generated 5% of alpha. By definition, you cannot generate alpha by owning the entire market through an index fund. Alpha is the result of being different from the benchmark and being right. It comes from making a few large, correct, and often non-consensus bets. The entire two-hard pile system is an engine designed to create the conditions necessary for alpha generation. By filtering out 99% of the market, it frees up the mental and financial resources to do the deep, painstaking work required to identify those rare, mispriced opportunities. This deep work is what builds true conviction. Conviction is the essential ingredient that allows an investor to make a large, concentrated bet when the opportunity arises. It's what allowed Buffett to put 40% of his partnership into American Express. He wasn't diversifying. He was concentrating his capital where he had the greatest informational and analytical edge. This is how you achieve life-changing returns. A portfolio of 100 stocks is unlikely to ever dramatically outperform the market, but a portfolio of 5 to 10 carefully selected, deeply understood businesses has the potential to do so. This is not about taking on more risk. It is about taking on more informed risk. The focus that the two-hard pile provides allows you to know your companies so well that the perceived risk is actually much lower than that of the diversifier's portfolio of unknown assets. This is the ultimate financial payoff for all the discipline that comes before it. It is how you transition from an investment strategy that simply tracks the economy to one that can truly build generational wealth. You have just spent time not just watching a video, but installing a new piece of software into your mental operating system. The two-hard pile is not just a folksy saying. It is a powerful, logical framework for making high-stakes decisions under conditions of uncertainty. You now possess the blueprint for a shield that will protect your capital from your own worst emotional impulses, particularly the destructive power of FOMO. You have the tools to define the boundaries of your own knowledge, to reject the allure of complexity, and to harness the immense, counterintuitive power of disciplined inaction. This is a mental tool that, once acquired, will serve you for the rest of your investing life, fundamentally changing the way you interact with the market and safeguarding your journey to financial freedom. But it is crucial to understand that Warren Buffett's system is not a single, isolated pillar. It is an interconnected web of mental models, a complete architecture for thinking about business and investing. The two-hard pile is the powerful gatekeeper, the first line of defense that determines which opportunities even get a chance to be analyzed. But what happens after a company passes that initial test? How do you then determine its true value? How do you assess the quality of its management? How do you decide on a price that gives you a margin of safety? The principle you've just mastered is designed to keep you out of bad businesses, but the next step is learning how to identify and value the truly great ones. The video that is now on your screen is not a random recommendation. It is the next piece of the map. It is the vital link that connects the principle of rejection to the principles of selection and valuation. Think of it this way: you have just built the impregnable walls of your financial fortress. The next video is about forging the key that unlocks the gate, but only for the opportunities that deserve to enter. It is the offensive strategy that complements the defensive one you have just mastered. The journey from a novice speculator to an intelligent investor is a process of assembling a complete mental arsenal. You have just added a powerful shield to your collection. The choice before you now is whether to stop or to reach for the sword. For those who are truly serious about this path, for those who see investing not as a hobby, but as the craft of building their future, the decision is clear. Complete your arsenal. Continue the ascent. Click the video.